Hey, it's Mike, and I want to share some investment wisdom from Warren Buffett, the greatest investor of all time. In case you don't know who he is the chairman of Berkshire Hathaway. It's a holding company that primarily works in insurance, but they also own parts of big companies like Coca-Cola and Apple. And Warren Buffett, over the 50 years that Berkshire has been around, they've returned at least 20% a year on average for the past 50 years. And you compare that to the S&P, which has returned on average about 9 to 10%. So he's doubled the performance of the S&P. And that's even more amazing because most, like 95 to 99% of Wall Street professionals can't beat the S&P 500. So let's take a look at Warren Buffett investment wisdoms because they're really down-to-earth, common sense wisdoms that you can apply even if you're just starting out investing, and you can use them for the rest of your life. So the biggest rule, the number one rule that he has is rule number one, don't lose money. Rule number two, don't forget rule number one. So that basically means when you start investing, you may be obsessed with how much money you can make. Hey, if I can find a stock that can double right away, that'll be awesome. But the problem is when you lose money in the stock market, it becomes a lot harder to get it back. So here's an example. Let's say you invest in a stock and that stock loses half its value. So it goes, you invested 10,000, it goes down to 5,000. Well, for your next investment, in order to get back to even, you have to double your money. You have to find a stock that gives you 100% return. So when you look at any investment strategy, look at how much you could possibly lose versus how much you can make. So for instance, that's why I don't recommend you buy calls and puts because you could lose 100% of your money if your timing is off. You want to do something a little more conservative, like I do cash secure puts, because you don't lose 100% of your money. And if the trade works against you, you can do a covered call and do a wheel strategy. So try to look at how to protect your downside. It's what hedge funds do. That's why they call it hedge funds, because they go long and short, because they want to make sure they don't lose a lot of money, because they lose a lot of money, then their clients will pull out their investments. So rule number one, don't lose money. Rule number two, don't forget rule number one. Second rule is opportunity comes infrequently. When it rains gold, put out a bucket, not a thimble. An example of great opportunities coming infrequently was we had that big COVID crash in March, and that was a time you had a once in a lifetime opportunity to buy certain stocks really cheap, and you had a lot of stocks double, triple, go up 400-500% in a couple months. So when you find these opportunities, go ahead and invest big. And usually it's companies that you know about, that you know they're good companies and they fell for no good reason, like the crash. You know, a company like Apple fell a lot during the crash because people thought no one's going to buy. But you know, over a 10-year period, the pandemic will end and Apple will still be a good company. So opportunity comes infrequently. When it rains gold, put out a bucket, not a thimble. Okay, number three, this is a very famous Warren Buffett quote. Be greedy when others are fearful and be fearful when others are greedy. Warren Buffett is known for not buying any companies or stocks when the stock market is moving up. He waits when there's a market crash and then he begins to buy. And this is a pretty good piece of wisdom here because you don't want to chase. You don't want what they call the FOMO, fear of missing out. Warren Buffett's really good at waiting. He has no fear of missing out. He can wait for his opportunity. So it's good to wait for your opportunities. If you like a certain stock, just maybe wait for it to pull back a little bit before you buy in. Again, cash secure puts, that's what I like about cash secure puts. I can own a stock at a cheaper price. But yeah, be greedy only when others are fearful. That's definitely a great way to make money over the long term. Another great piece of wisdom: it's far better to be a wonderful company at a fair price than a fair company at a wonderful price. So this is basically about picking quality companies. It's better to find a company, even if you got to pay a little more for it, that has earnings that are continually to rise. The company is having increasing sales and a big moat that Warren Buffett likes to talk about. Like a company like Coca-Cola has a big moat because there are not a lot of other soda companies that could disrupt it or compete with it. So, if you got to pay a little more for Coca-Cola, like paying a little more for Coca-Cola is better than buying XYZ company at a great price that has no real profits or anything like that. So rule number 5, the most important quality for investors is temperament, not intellect. And I think this is huge because I learned a lot from this. When I started investing in the late 90s was the dot-com boom. And I was chasing companies like Yahoo, AOL, Apple, Amazon at the time. And I became too emotionally involved in my investments. And you don't want to do that. It's kind of like you can't treat the stock market like gambling because, when you gamble, if you put $20 on a football game, you become emotionally invested in the football game. You don't want to become emotionally invested in your investing. What you really want to do in your investing is just find your edge and let the edge work for you. So your edge can be just going long the S&P 500, because the S&P 500 returns on average 9% a year. So if the S&P 500 has a down year, you can't panic and sell. You just say, okay, well, over a 5-10 year term, it's going to return on average 9%. So just hold on and not become emotionally involved with your investments. Number six, the stock market is a no strike game. You don't have to swing at everything, wait for your pitch. And basically that means that, in baseball, you can strike out without swinging at a ball if the pitcher throws 3 strikes over the plate and you don't swing. In the stock market, you really don't lose money if you don't invest. I mean, yes, if your money sits in cash, incrementally you lose, a little money at a time. But if you invest all the time, you're most likely to lose money, because sometimes you'll make some poor choices when you invest. Just wait for the opportunities that are most likely to be profitable. So, wait for stocks to rise above the 50-day moving average. Wait for stocks that are have good earnings, or whatever fits your criteria of what a great stock is. Just don't panic just because you have cash and feel like you have to invest in everything. Wait for your big opportunities. And finally, if you like to spend 6 to 8 hours a week working on your investments, then do it. If not, dollar cost average. And I think a lot of you, if you're watching this video, you probably spend time working on your investments, so that's good. However, if you don't have the time, just dollar cost average in. Like if you have $1,000 to invest every month, then just put $1,000 in. You don't have to put all your money in at one time, because when you dollar cost average in, you're buying when the market's high, when it's low, but over an average, you get a good price for your investments. But I think it's great advice if you're just like, you don't have the time to work on your investments. So I highly recommend, looking Warren Buffett. There are lots of videos on Warren Buffett's wisdoms, like his conferences and his annual shareholder meeting. He does like a 4-hour Q&A, and those are great videos to watch, because you really get invaluable wisdom from watching those videos. So I highly recommend them. So hope you will enjoy this video. If you did, please be sure to like, share, and subscribe. I do daily updates on breaking news on the stock market, and I also do some educational videos on the weekend. Okay, thank you very much. Bye.